Hi, I'm Dr. A. Saranya, Assistant Professor, Department of Commerce IT. Today, we are going to see national income measurement methods, how the national income is measured, and what are the types that we measure the national income. Okay. National income measurement is the total value of goods and services produced by a nation. It is crucial for economic policy, fiscal policy, and global comparisons with key metrics like GDP and GNI, gross domestic product, and gross national income. National income is the total value of goods and services that is produced by a nation will be calculated, and it will be calculated in different methods. Some of the methods will be discussed here. Okay. Why do we measure the national income? It is essential to measure the national income for basic and important four things. One is economic performance, policy formulation, international comparisons, and resource allocation. In the economic performance, it assesses the growth, recession, business cycle, providing a clear picture of the economic health that is prevailing inside the country. Next, for the formation of some policies which informs the fiscal and monetary policies such as tax cuts or interest rate adjustments will be taken care under this policy formulation. When coming to international comparisons, benchmarks economic strengths and living standards, facilitating the global economic analysis. Entire global economic analysis could be facilitated by strengthening the backbone or setting benchmarks for the income. Next, last, resource allocation. It guides the investment decisions and identifies sector strength or weakness for strategic planning, which is an important task of the nation. Okay. As we have seen in the previous video itself, the national income, uh, these are the key components: gross domestic product, gross national product, nominal versus real GDP. That is, the nominal GDP uses the current prices, whereas the real GDP adjusts for inflation, offering a true measure of output changes. Say, for example, the GDP, nominal GDP is around $1 billion. The real GDP will get adjusted to the inflation, and it will show for the future forecasts of the country where inflation takes place. And GNI is gross national income, where we calculate the net GDP plus net income from abroad. The per capita income is the total income, that is the total national income divided by the population, indicating the average standard of living and economic well-being of the people living there. Next, we have the expenditure approach of calculating the national income. This approach sums up all the spendings on final goods and services in an economy to calculate the national income. The summing of all spendings like consumption, investment, government spendings, exports, that is net exports. When we get net exports means exports minus the imports will give us the net exports. In this expenditure approach, we can calculate, or we can calculate the national income by summing up or adding all the consumption, investment, capital spendings, and net exports. When coming to income approach, this method calculates national income by summing all the incomes that is earned by the factors of production within the economy. This method calculates all the incomes that is earned by different factors of production. As we all know, the factors of production are land, labor, capital, organization, and entrepreneur. Within those factors of production, how the economy is attaining the incomes. Let's say, take examples like compensation of employees, proprietors' income, net interest, corporate profits, rental profits or rental incomes, etc., plus indirect business taxes and depreciation. If these summing up all the earnings will give us the national income under the income approach method of calculating the national income. And production approach, that is value or output added approach. This approach measures the market value of goods and services provided or produced by summing up the value added at each stage of production to avoid the double counting of the value added, like raw materials, assembly and manufacturing, intermediate goods, final product sale, everything will be calculated separately. This method provides an insight into the contribution of different economic sectors like manufacturing, services, and agriculture. The three methods of calculating national income are expenditure method, income method, and production approach.